Good evening, ladies and gentlemen. Once again, we are entering into the wealth management for working professionals series number 7. So, till now, we have covered a lot related to Warren Buffett's 12 principles, how he applies to all his investment decisions. Especially, we have gone into the details of four case studies. One is Washington Post, then Geco Corporation, Capital Cities and ABC and Coca-Cola Company. And we have seen how these principles are being used, and each principle is discussed at length. And now we will be using the same principles when it comes to other securities, especially fixed income securities. Usually there are three, four categories which fall into fixed securities. Number one is the cash in the sense we tend to make use of them by putting the cash into either into banks or debt markets that generate some amount of interest. And then there is something called as a bonds are issued basically by either the government or by the corporates. So depending on the bond rates and the percentage of the coupon rate, the so-called the interest which they attach to each bond is basically a coupon rate. And there is an interesting story behind why it is called as a coupon. In the past, when it used to be a paper kind of a transaction, so each bond came with it a kind of a coupon which is to be produced either to the broker or with the bank, so that they would used to pay that interest charges whatever as per written in the bond. Usually the bond coupon rate can be, usually it will be annual payment. In some cases it may be semi-annual, it may be quarterly, and depending on what kind of a bond they are giving and what is the periodicity. And then there is another category called as a preferred stocks. Preferred stocks are basically they are with a fixed dividend, irrespective whether the common stock are being paid dividend or not. These particular preferred stocks will be paid dividend. And sometimes these preferred stocks are convertible. They are converted into common stock at a particular predetermined rate and only after expiry of a particular period. So it gives the owner of preferred stock a right to sell that particular, or rather purchase the common stocks from and take the so-called, control in that particular company. So this is in nutshell about the various kinds of fixed securities. And before we start, once again, we'll discuss a little bit about what are the principles which are generally used in your investment decisions. These are strictly not just for only the so-called equities; they are also for every kind of investment decision. So let us once again quickly relook at what but those principles are 12 principles. The 12 principles fall into four categories. Category number one is business principles or business tenets. And the second category is management. Third is finance. And finally, it is value tenets. So let us try to understand quickly what these principles are. Number one, first principle is the business simple and understandable. So by this, what it means is, are you exactly understanding what the principle is, what the business model is, and do you understand anything? If you don't understand anything, better don't try to understand, because there is a Philip Fisher, when he propounded certain principles for investment, he clearly stated that whenever he invested out of his circle of competence, he always lost, a lot of money, or rather, he is not very successful in his investment decisions. So, whereas when he applied these same principles when in those areas where it fall under his circle of competence, naturally he got huge benefits. And then he understood that it is the circle of competency which decides and determines whether you understand the business or not. Usually, circle of competence is the area in which you are familiar with, usually maybe out of work experience or handling those kind of a thing. You understand the inside stories of each and everything. Suppose you are say, you are into a software engineer. You are a software engineer working for an IT company. Naturally, the software, the computer technologies, the information technology, and the related technologies like cloud computing, artificial intelligence, your data analytics, all these things would be your forte. You are basically you will understand everything about this, and once you have understanding in that particular area, definitely it will translate into a better decision making. And the second principle in business is, does the business have consistent operating history? And in this, you have to see how consistent the company is right from the beginning of its journey as a company. So you have to see whether it is consistently performing, is it growing continuously, and generating enough profit or capital appreciation. Or they are being run very professionally and consistently over a long period of times. So this is about that principle. And the third principle is, does the business have favorable long-term prospects? It's a very, very important tenet. Like, unless the business is in very favorable long-term prospects, there is no point putting money into it. Like, in case of Warren Buffett, he tried to, you know, turn around the textile mills which he has purchased when he purchased Berkshire Hathaway, which initially was basically a textile company, usually in the New England, that is northeastern seaboard of United States of America. However, due to unfavorable, economics, because that was a time when the countries like Bangladesh, India, and other China, these are the countries which are giving huge amount of, competition to American textile industry. And slowly that textile industry, despite putting the best of the best managers and best managerial principles and putting a lot of money into it, however, that company has failed because the business has an unfavorable long-term prospect. So, whatever, however brilliant you may be, however, capable, the management may be, the kind of benchmarks they are setting up, and the infusion of capital. But if the business has unfavorable long-term prospect, that entire money will be totally, it will be wiped out. So it's always better to have go into a business which have a favorable long-term prospects. For that, you need to understand the business life cycles, the business, the economy in which it is into, and the competitors, and you have to have an understanding, fair understanding of Porter's five forces and all these things. When you have that understanding, then you can understand whether the business is in favorable long-term prospect or not. And then I think in the previous session also I have discussed a little more about this principle. So now let us go to the management tenets, and it is the management which either make or break any corporation. So it is the managerial decisions and the management who drive through the difficult, uncertain environment and ensure that the company is performing well. And if the management is quite capable, they are honest, and they are very rational, only then such kind of companies thrive. Otherwise, if it is into wrong hands, even if the business prospect is favorable, especially in the long term, despite that, the companies fail because it is because of the fact that management has been either irrational, or they are not frank, though they are very capable. They are trying to cook the books, or they had some dealing something like, related party transactions which are in their favor, whereas it is not in the favor of the company. So we need to be very careful about the management and their style of management and what kind of a decisions do they take. There are three principles regarding it, and these are the three fundamental principles which you always have to apply to understand the the gravity, or to understand the management potential, and the way they are uh, taking the company forward. So, first principle is the management rational? If the management is irrational and they are not taking any decisions based on proper study, or with the right kind of information, and they are very sentimental, or very much, got you can say very much bothered, or they are tempted by certain, whimsical spurs, which is not based on a rational kind of a thing. Naturally, the company is bound to take wrong decisions, which the company might suffer in future to come. So management has to be rational. We mean by rational means they are taking prudent, and any person with common prudence would apply certain principles, that would be good in the long run, like, doing a proper study, understanding the problem in the right light, defining the problem, then identifying the alternatives, whether right kind of alternatives are taken into consideration, then what if and doing a lot of what if scenarios, and out of those scenario analysis, whatever is the best suitable for the company, that has to be. And rational is based on a detailed brainstorming, and also taking into consideration all the viewpoints, a balanced judgment, rather than becoming too sentimental, or or any kind of a knee-jerk reaction for every kind of small even event, and becoming too emotional or sentimental. These are the things which you need to look into. Then, then comes is management candid with its shareholders? This is a very, very important principle. Like, many a times, management tend to be, very frank and free in giving you details when the company is doing well. But whereas when the company is not doing well, they try to suppress a lot of information or misrepresent. Uh, uh, you know, Many times we observe that management, during when the things are not going well, or when the company is in bad patches or bad phases, naturally they will try to hide certain information, or they'll try to cook the books, and then project as if everything is rosy, and giving you a wrong picture. So these kind of managerial attitudes, and kind of a communication is very dangerous for any company, and many a times those companies have totally failed very miserably. And what you need to see is, the major test is when, how do the management, means the leader or the chairman or CEO of the company, how do he behave when the things are not well? So if he behaves in a very free and frank manner, open manner, in which he admits what is the exact condition, why the company is not doing well, and what are the action plan they are going to take. All these kind of things are very important. At times, you know, people tend to ignore a elephant in the room, and elephant being mischievous will do whatever the damage it has to do. So we have to be very careful about such kind of managers. So better choose a manager who is very quite candid, and he is very frank and openly admits whenever he or she is at mistake. So this is the trait we need to observe. Then the next principle is that, does management resist the institutional imperative? Here, institutional imperative means the temptation to take certain foolish decisions. Like in case of yesterday's case study, when ABC and sorry, Capital Cities ABC company under Murphy. So Murphy had around 2.3 billion dollars of excess cash. So generally, in such a scenario, many of the managers would be tempted to put that money into wasteful expenditure and then go for expansion, mindless expansion without having a proper thinking. And Murphy, being a very prudent kind of a manager, he understood there is no point, purchasing any assets which are, especially they wanted to purchase property in better cities. So he was waiting till he get a right kind of a price, and he was not willing to pay any price. So he waited, and instead he focused on reducing the debt, and then paying repay, and also going for a buyback in which the company has reduced number of shares and purchased it directly from the investors. So that is how we need to look at things. We need to see whether the management is taking right kind of a steps, and are they cutting the cost, are they always in search for two fundamental things. Number one is increasing the shareholders wealth, either through capital appreciation, or through paying dividend to the investors. So these are that should be the motive of management. And whenever there is a conflict between management and shareholders, naturally that is not good for the company in the long run. So one has to be very wary about such kind of actions by the top management. Next is related to financial tenets. Uh, They are basically the first one is what is the return on equity. Return on equity is nothing but what is the returns generally is generated by the equity. So the earning is basically a bit earnings before in interest and taxation. So you have to divide it by the amount of equity in that company. So if the proportion, say the return on equity of any particular company is above average, and they are doing better than their peers, naturally that is where we need to look into. And also another test is like we need to know what is the risk free interest. And if we know, say for in Indian context it is 7.2 percentage. So a company, if it is not producing a return on equity of more than 7.2 percentage, there is no point putting money into it. Better you put into a fixed deposit or into some other debt instrument. Then the second aspect is, as we have discussed in the previous sessions, there is something, relationship between risk and return. The higher the risky any investment is, the more returns you have to expect. So equity being more riskier investment, you have to expect more than what a risk-free returns are giving. Like bank interest is giving you 7.2 percentage, you should not be happy with that, because there is something called as a risk premium. So you have to take that premium for investing into equity. So usually it has to be at least 3 percentage above the risk-free return. Like if it is 7 percentage risk-free return, then you have to add at least 3 percentage, which is around 10 percentage. And depending on kind of company you are investing into, more the risky a company is, the more the return on equity you have to expect. So this is how you have to apply this principle. Then the next is, what is the owner's earning? Company's owner's earning. See, company's owner's earning is nothing but a PAT, profit after tax. Like whatever the left out residual income of a company after paying all the liabilities, like the so-called operating expenses, administrative expenses, then your interest charges, depreciation, amortization, then your taxation. After that, whatever is left out, that is the owner's earnings. That owner's earnings, it can be either distributed in the form of a dividend, or else it may be retained and kept as retained earnings for usage either into capex capital expenditure or OPEX, operating expenditure. So any company which generates good amount of decent owners earnings are said to be a well-run company, well professionally managed company. Then the ninth is, what are the profit margins? Profit margin is nothing but the percentage or the amount of net profit after paying all the liabilities with that of sales, whatever the percentage is, that is called as profit margin. And profit margins, what you need to look at it is, you need not have exceptionally excellent kind of a profit margins. You need to see a company which is giving above average kind of returns. That is the company which you have to look into and look at. And any company which is not performing performing better than average of its the average of that particular industry, then naturally you need to rethink whether you have to invest into it, unless you have got total faith in the manager and the management and their ability to increase the profit margins. Like we have discussed when it comes to the case studies in Coca-Cola and also Washington Post, and then in Geico. So you need to look at those kind of things. You need to have faith in the management and their ability to deliver a good amount of decent profits compared to their peers. And then the next principle is, has the company created at least $1 of market value for every dollar retained? See, retained earnings will form the bulk of the investment by the company into either OPEX or CAPEX. And if they are putting that money, and we expect that they generate at least more than what is being invested. If they don't generate more than what is being invested, that means the company is into losses, and losses are in the long run unsustainable, and it may lead to, unless right kind of a action is taken, it may lead to bankruptcy of that particular company. On for sometimes it falter and finally it totally is closed or collapsed. So you need to understand that you have to check whether these whatever the capital which is being invested is generating enough returns and giving the owners the earnings and also the dividends in the form of, unless that is being given, there is no point investing into such kind of companies which are not generating enough market surpluses. Then comes is the value tenet. What is the value of the company? Many times we all tend to get confused between price and value. Value and price are totally different. Price is what you pay and value is what you get. By value, it means the intrinsic value of a company. It is the capacity of the company to generate, incomes over a long period of time. And that particular thing, by using discounted cash flow method, you calculate the value of a particular company. And there are certain formulas we have discussed in the last session, how to calculate in three scenarios. When in the first scenario, we have seen, when there is constant growth, where you don't expect the market to outperform the inflation. So in that scenario, it will be like, value of a company is the earnings or the cash flow, current cash flow divided by the risk free return. And in cases where the company is growing constantly at a particular rate, and then that rate is lesser than that of risk-free return, then the formula will be like current cash flows divided by risk-free return minus growth. And then in the third scenario, when there is a period of 10 years in which the company is performing at better than the so-called risk-free return, then you have to make a two-stage valuation statement. In the first stage, you have to calculate based on discounted cash flow. and also compounding factor, that is a compounding growth factor. And then you have to add a terminal value based on again the formula which is being said, like if there is not much of a growth anticipated, then the formula is as simple as I have described in the initial stage. Then the second stage is in case if the company is expected to grow at a particular rate but below the risk-free rate, naturally it will be, or the cash flow divided by, that is terminal cash flow divided by rate, risk-free rate minus growth. So this is how you calculate the valuation of a company, and you have to add both discounted cash flow for 10 years plus this terminal value. If you add both, you will get the value of a company, which we did when we calculated the valuation of Coca-Cola. So I think that will make things very clear. And then the final tenet is, can it be purchased at a significant discount to its value? Many a times the best decision, investment decisions are when you purchase a good company at a decent discount to its value. Naturally, that is said to be a good decision. But however, it may not be every time it has to be the same. Like in case of Coca-Cola, Warren Buffett had to pay market premium for the value. Even he has paid more than the market price which it commanded in the market. So that is based on, the company being an outstanding company, having a very long term favorable business, or long term favorable economy. And then second aspect is that that company is growing very rapidly. So in such a case scenario, you can pay the premium. So these are the principles which he has applied. Now let us go to those case which we are about to discuss, that is related to the fixed income securities other than equities. So what are the principles we apply, and what are they, how Warren Buffett tend to make his decisions. So uh, now, in fact, fixed income investing is one of the Buffett's outlet, provided as always that there are undervalued opportunities. What he does is he try to seek out at any time those investments and provide the highest after tax returns. So this is the criteria in which he goes. Like any investment, see, he makes a calculation. What is the coupon rate and what is the returns which they are generating after taking into consideration whatever the tax that needs to be paid. So in recent years, the debt market, like he entered into debt market because corporate and government bonds, convertible bonds, and convertible preferred stocks, and even into high yielding junk bonds. These are the areas where he has entered into, because there is not much of pulp left out in the regular markets like equity markets, and it became highly difficult to find out what is the best suitable equity investment. So it was becoming more and more difficult because the American markets have entered into the phase of the so-called maturity. In matured markets, naturally the opportunities will be quite less, and you have to really wait for a right kind of an opportunity. That is where he felt that it's always safe to go for fixed income securities, which are highly secured, and the possibility of getting a fixed income is very high. And while taking into consideration, he always gone for, to find out whichever company is giving the highest after tax return, that is the company in which he would be interested to invest into. So he always looks at margin of safety and the commitment by the company to the and their capacity to repay the debt back. And then because there is always a see with the fixed income securities, there are two kinds of risk. One is the risk of default, principal default, and the risk of default in terms of paying the interest. So these are the two defaults. How to insulate yourself from such kind of risk is to see the behavior of the company, understand the management, their core goals, and what is their credentials, and whether they are fulfilling their whatever demands usually they are said to have. So if any company that doesn't comply to such kind of a thing, and they are not they are notorious regarding payment to their creditors, naturally you have to avoid such kind of companies. Rather, you have to pick those companies which have excellent reputation for honoring the commitments, especially against the creditors, whether long term or short term. And those are kind of companies where you need to invest. And second, and the most important criteria is he will always go for lower prices. That is the bargain price. So that we will discuss in case studies how he generally get into those kind of things. Then the next is he generally insists on strong and honest management, as we have discussed in the case studies when it come during our discussion regarding equities. And then and also those people who make good allocation of the capital, because whatever the capital, whether it is equity or debt, that is being deployed for various purposes. It may be capital expenditure, or reducing the debt burden, or to take care of operating expenses. And unless they make a right kind of allocation, otherwise it may lead to one wasteful expenditure, and expansion may be highly problematic, or the management might have made certain errors in judging capital allocation. And if they don't make a appropriate correct kind of a allocation, naturally it is bound to have its effect on the financial health of the company, and also a potential for profit. So potential for profit is very important, because after all we invest. As an investor, we expect decent profits, if not outstanding, but at least decent. So his decisions do not depend on the hot trends. He don't go into what is hot in the market, what kind of things are doing well, or many a times people wanted to time the market in such a way that they wanted to go into a perfect entry when it is very low, and then they quit at when it is high. So there is no such kind of a thing, which usually people like other sophisticated investors generally tend to do. But what Buffett believes is that there are undervalued assets and securities where there will be opportunities. So he generally look out for them, and he generally invests into such kind of opportunities. Now let us understand why fixed income securities are very important. And see, when it comes to fixed security investment, at one stage in 1992, the fixed income securities were 20 percentage of Berkshire's investment portfolio, whereas 14 years later, that is in 2006, it went up to 30 percentage, and right now almost 30 to 40 percentage is what Warren Buffett is investing into in this fixed income kind of securities, because as I said in the past, the more the market discovers the right appropriate price, and all the information is already discounted by the market, you hardly is left out with any good opportunities, and then that gives you decent kind of a return. So the best kind of a return where you get a fixed the income is, or a regular stream of income is, basically fixed income securities. And the reason for adding these fixed income investments are very simple. They were best value at the time, and because of the absolute growth of Berkshire Hathaway portfolio and changing investment environment, including a lack of publicly traded stocks that he find attractive, Buffett often turned to entire buying entire companies and to acquiring fixed income securities. So as it is being said, because there are very few attractive opportunities available in the market, he now shifted his previous strategy of taking some amount of equity to purchasing the entire company or acquiring income securities, fixed income securities. So these are the two strategies he is adopting of late. So you need to we can get a lot of cues about this, and we in any case currently India is in emerging market stage, so it's in the stage of growth. So once the growth flattens and enters the matured phase, sooner or later we will be entering into such a phase, then we have to rethink about our strategies from putting into any kind of iniquity or any company which is doing moderately well to going for or purchasing an entire company. If not, we may not be becoming such a big investor to buy an entire company. Rather, we will be, putting our money into those companies which are giving you a decent kind of a return, and they are doing quite exceedingly well. And the shift will be towards fixed income securities. So, an insurance company heavily invested in bonds in hyperinflationary environment has potential to wipe out portfolio for a simple reason, like as we discussed in the online session. So generally, whenever there is a hyperinflation, the bond will get generally a kind of a fixed income, say risk-free return is say 7%, whereas the inflation is 10%. So inflation has already wiped out whatever the income you are getting. So you have to be very, very, and insurance companies, whosoever are into it, they should avoid investing into bonds in hyperinflationary environment. Otherwise, it will, wipe out whatever it has, and they may fall short of, you can say, the claims which generally are made by the claimants. Then the second aspect is you will fall short of required expenditure, because all the expenditure is based on the current whatever the value, as per the current market trends you have to expend, and you cannot spend based on the previous expenses. So during inflation, everything keeps on increasing, the job will keep increasing, then any kind of purchases, they also be very expensive. So you have to be very careful in such kind of an environment. Then next one is fixed income transactions. His business owner's perspective means that he pays close attention to company's management, values, and performance. As we have discussed, like Warren Buffett used to pay a lot of attention, just like equities, regarding the company's management, their values, their performance, their behavior, and their candidness, and the kind of rational decisions they are taking. So these are the criteria he again looks into it, and his approach is basically bond as a business approach. He don't look bond as a bond, a fixed income asset. Rather, he checks into whether bond is like a business, like he takes all the decisions just like he when he purchases any particular business. So that is the approach he took, and this is what any kind of a prudent investor has to take into it. Now let us see, there are few case studies. Number one case study is a public Washington Public Power Supply Company. Actually, in on July 25th, 1983, WPPSS, pronounced as Whoops, announced that it was in default of 2.25 billion in municipal bonds used to finance the uncompleted construction of two nuclear reactors, which are known as Project 5 and 6, 4 and 5. Whereas they already had the Project 1, 2, 3 in place, they are doing quite well. However, they had a problem with Project 4 and 5. The state ruled that the local authorities were not obliged to pay WPPSS for power they previously promised but but to buy, but ultimately did not require. So there was a decision. The state, that is Washington State, they have decided that the local authorities are not obliged to pay WPPS because they have failed, defaulted on, 2.5 25 billion in municipal bonds. So they are not honoring any further the commitment. That decision led to largest municipal bond default in the US history. The size of default and debacle that followed depressed the entire market for public power bonds for several years. Investors moved quickly to sell their utility bonds, forcing prices lower and current yields higher. The cloud over WPPSS project 4 and 5 cast shadow over project 1, 2, 3, which were doing quite well. But the Buffett perceived there are significant differences in the terms and obligations of project 4 and 5 on one hand, and those of project 1, 2, 3 on the other. And the first three were operational utilities that were under direct obligations of Bonneville Power Administration, a government agency. However, the problem of project 4 and 5 were so severe that some were predicting that they could weaken the credit position of Bonneville Power. So this is a nutshell. Like there was a very strong headwinds in the market that the failure of project 4 and 5 would affect ultimately the project 1, 2, 3. And what Buffett observed is that Bonneville Power, say, the project 1, 2, 3 do not have such kind of a problems because they are already operational and they had an obligation of Bonneville Power uh, administration, which is a government agency. So this is his, you can say a gut feeling or a gut factor. So he went ahead with this investment. And shortly after Project 4 and 5 defaulted, Standard and Poor suspended its ratings on Project 1, 2, 3. And the lowest coupon bond of Project 1, 2, 3 sank to 40 cents on dollar and produced a current yield of 15 to 17 percentage tax free. This is a huge opportunity. I'll just show you how it is a huge opportunity. Then the highest coupon bond fell from 80 cents on a dollar, generated a similar yield, and undismayed from October 2000, 1983 through June the following year, that is 1984, Buffett aggressively purchased the bonds issued by WPPSS for projects 1, 2, and 3. By the end of June 1984, Berkshire Hathaway owned 139 million of WPPSS project 1, 2, 3 bonds, both low coupon and high coupon, with a face value of 205 million. This is a huge deal. And WPPSS explains Buffett Berkshire acquired 139 million business that would expect 22.7 million after tax, which is roughly 16.33 per annum. The cumulative value of WPPS's annual coupons would pay the earnings to Berkshire in cash. And Warren Buffett points out that there are few businesses available for purchase during this time, and that was selling at a discount to the book value and earning 16.3 percentage after tax on unleveraged capital. The Buffett figured that if he set out to purchase an unleveraged company operating earning 22.7 million after tax, 45 trillion pre-tax, that means 50 percentage is the taxation in the United States of America. It could cost Berkshire between 240, 230, 250 to 300 million, assuming that he would find one. So he has purchased that company at 139 million dollars, which is almost you can say is 80 percentage to 120 percentage cheaper compared to what he would otherwise have spent on it. So Buffett admits that the purchase of WPPS's bond turned out to be better than he expected. Indeed, the bonds outperformed the most business acquisitions made in 1983. So now let us do a little calculations and how he arrived at and what is that he got benefited. So let us see, let us make a calculation. Here, unfortunately, I don't think we had got what is the coupon rate. Coupon rate is not given in this. We will try to derive what is the coupon rate from what is being given, right? So let us take an example, like say, usually in bonds, usually there is something called as a face value, right? There is something called as coupon rate. Usually, face value of any bond will be, say 100 rupees, 100 rupees or $100 is usually when any company issues bond. So the face value will determine the interest rate or coupon rate. Usually, it is somewhere around say 6 to 7 percentage or 7 percentage. Let us assume it has a coupon rate. So the purchase rate is totally dependent on the rate at which that particular thing is being purchased. So suppose he has purchased at 100 rupees. So for 10 years, it is a coupon with a kind of a bond, say for 10 years of maturity. So what he will be getting at the end of the period is every year 10 percentage of 100 is around 10 rupees, right? So it kept on, it keeps on increasing, and this is what any person who has invested into bonds will be receiving. Suppose let us take only 5 years. Okay, there is a coupon bond with a face value of 100, and that 100 will give you a constant interest of 100 rupees per year, right? And there is a say coupon rate is 7 percentage, whereas discount rate discount factor is risk free rate, which is say 6 percentage. So if you calculate the net present value at the end of fifth year, so what he will be getting is this will be 10 divided by 1.05. So this is what the NPV, if you apply NPV formula, this is what. And then here, since it is, already discounted for 1, so what we will do is we will again divide it by 1.05. Sorry, 1.06. Here also we have to change it to 1.06 because that is the discount factor we have taken. So now again you apply the same discount factor even here also, divided by 1.06, or for our easy convenience I'll just put here the 1.06 factor, discount factor, or I call it as DF, right? So here what I'll do is I'll just divide this by the discount factor. So, and this one also.
And finally, since you have already paid the face value of 100 rupees, 100 rupees will be returned back to you. So you will get 100 rupees at the end of fifth year. This is the interest which you got for 5 years, and this principal also is repaid. Let us see what is the present value of the principal after 5 years. We have to multiply it by 5 times the same discounting factor. So now let us see what is it. Oh, it has taken it in the other way. I have to close with the brackets. So let us make a calculation of what is being received. So you have got 116 rupees at the end of, for an investment of a face value of 100 rupees. So the overall, during the entire of the period, the amount of money you have, the generated or the percentage growth is 16.84 percentage is what you have got as in return for 5 years. So even if you take a simple calculation, it is somewhere around 3 point some percentage, 3.5 or something. Let us see how much, is the return. Minus 100, 100. So this is 16. This is the, in terms of percentage, 16.84. This is the returns, overall returns. Then if you make a annual return, AR, using a simple, instead of, compounded, because it is all, basically it is given based on simple interest. So let us divide it by 5. 5 is the number of years in which we got that interest. So what we got is only 3.369 percentage in terms of the so-called NPV, based on NPV formula. So this is how we need to calculate whether what we are getting is a decent return or above that of discount rate is nothing but risk-free rate. So sometimes inflation is also added into it. But since we don't know the value of inflation, we always better go with the risk-free return. So even despite that, yes, you are generating some surpluses, so that's a good investment. So this is how you need to calculate. And what if the face value has become reduced? Okay, say instead the sorry purchase rate is, instead of 100, you have purchased it for 60 rupees. So what is it? What is the benefit you got? That is where Warren Buffett did. So he only spent only 60 rupees, but he got at the end of, you know, uh, uh, you can say at the end of the period, he got 100 rupees. So initial investment now, returns will be, I'll just calculate it. This G8 minus 60, or rather this one. So if I put this, see, he got a return of 56.84 percentage, whereas the annual return is 11.36 percentage. Just you compare 3 percentage with 11 percentage. This is how you need to take any kind of a decision. And if say instead of 60, you have purchased it for say 40 rupees. So it is 76.84 percentage return, and annual return is 15.36 percentage. This is how you need to make calculation when it comes to bonds. So I think this will help you understand. There are many methods, but anyway, this is how a bond is usually valued whether as an instrument. Now let us try to calculate what is the value Warren Buffett has got as per this case study. So I'm opening additional sheet to just show you how it turns out to be. So now I'm making it a little larger so that you all can see it. This case study is related to uh,
So now let us see the entire of the bond calculation. The purchase price for that particular WPPSS bond is 139 millions, whereas the face value of that particular bond is 205 million, and annual interest which you will be getting is 22.7 million every year. So the coupon rate based on the information given is 11.07. And then let us assume based on the case study, we identified risk-free rate as 9%. So this is the discounting factor is 1.0 now. So every year this coupon or the bond is generating 22.7 million as a fixed income. So the present value in terms of millions is, you have to take this. I'll just show you the calculation here. This is the income divided by the discounting factor. For it, since it is first year only once, and since we have already calculated at the end of first year, we just what we need to do here is this value divided by the discounting factor. So if we keep on doing like this, you'll get to have various figures for 5 years. Year one, I'll write here year one. Okay. Then year two, then you have third is year three, year four, and then this is year five, and finally this is at the maturity he will get back the initial investment he made, that is after completion of 5 years. So this is a hypothetical case, it's not the actual case. Based on the information given, I just calculated what is the actual, the returns from that particular bond, and at the maturity this 205 million which he has invested will become 133.2359, depending on the discounting factor as 9% risk free rate. And the total income based on, after adding all these things, it is 221.58. So the total profit he derived after investing is 82.53 million, whereas the total profit is 57.37 percentage over a span of 5 years, which is a very quite decent interest. And annually he got somewhere around 11.87%. What if we have just tweaked instead of 9 percentage, we made it as 8 percentage? Let us see how will this entire of the thing will change. So, see, you just 1 percentage reduction, the annual profit has increased to 13.12, and in any case, bond coupon, the risk-free rates kept on, lowering in the market. If it is say, I put it as say 6 percentage instead of 9 percentage initially taken. So there you will land up in annual profit of 15.80. And reverse is also true. What if a risk-free interest rate is not 6 percentage and it is 10 percentage? So the entire calculations will keep changing. See, this is how he got, profit. And this is how you need to make a calculation of, coupon bond rates. So this is how you can exactly derive the value for every kind of investment. And this is the table. It's a quite simple table, nothing very complicated. What you need to know is you need to understand the, discounted cash flow formula. Discounted cash flow formula is sigma. I'll just check it up, and I'll just send it in the group itself, because that would be better. Otherwise, here I don't think there are so many symbols available here. I can't make it unless I get it from the so-called internet and stick that formula. Anyway, I'll just send it in the group itself. So this is how you have to make calculations whether the NPV is positive or negative, and what is the percentage returns. And if you don't do any NPV, let us assume instead of using the PV formula, we are just we are just adding in absolute numbers. Let us add absolute numbers and see how we derived at that profit.
So if we add the absolute numbers, 318.5 million, and then if you calculate the profitability, it will be divided by 139, which he has invested. So it is around, uh, if I change the format, the percentages, then it is 229.14 percentage. Let us see the annual, the total profit. Sorry, sorry. Wait a minute. This, this is related to total profit minus 139 he invested initially. So the total profit is, I'll again rechange to just numbers. So in absolute terms, 179.750 million is what he has got as a profit. Now let us see what is the total profit out of what he has invested. He invested 139 million. So this is, in terms of percentages, it is 129.14 percentage. What is the average annual profit? This is this divided by 5. So it is 25.82 percentage or 83% if you round it. So this is in nutshell about how you have to calculate, you know, the net profits. One by PV method, and the other one is absolute method. But PV method gives you the correct valuation after discounting, using the discounting factor. So it all depends on what is the factor of discounting. So at that time, based on the case studies, we have got it as 9 percentage. So the discounting factor will be 1.09. So see the change in the numbers. So this is how you need to calculate while calculating the bond values, bond valuation. This will be very useful when you are taking any kind of a decision related to valuations. So now let us go to the next case study. In the next case study, it is about RJR Nabisco. This is also a kind of instead of, there are two kind of this one. One is a junk bond and the other is fallen angel. Fallen angels are those companies that fell from reputation, as we have seen in case of WPPSS. Now let us see the case of the so-called junk bonds. See, in Buffett's view, the new high yield bonds were different from their predecessor fallen angels, which we discussed just now. Buffett's term for investment grade bonds that have fallen on bad times were downgraded by rating agencies. The WPPSS bonds were fallen angels. He described the new high yield bonds as bastardized form of fallen angels, and he said were junk before they were issued. Buffett argued that the earlier default statistics were meaningless since they were based on group of bonds that differed significantly from the junk bonds currently being used. It was illogical, he said, to assume that the junk bonds were identical to fallen angels. There was an error similar to checking historical death rate of from Kool Aid before the version served at Johnston. As 1980s unfolded, high yield bonds became junkier as new offerings flooded the market. The mountains of junk bonds, noted Warren Buffett, were sold by those who don't care to think, that didn't think, and there was no shortage of either. At the height of the debt mania, Buffett predicted that certain capital enterprises were guaranteed to fail when it became apparent that the debt laden companies were struggling to meet their interest payments. In 1989, Southmark Corporation and Integrated Resources both defaulted on their bonds. Even Corporation, a US retailing empire created with junk bonds, announced it was difficulty it was having difficulty meeting its debt obligations. Then on October 1989, UAL corporation, the target of 6.8 billion management union led buyout that was to be financed with high yield bonds, announced that it was able to obtain financing. Arbitrageurs sold their UAL common stock position, and Dow Jones Industrial average dropped 190 points in one day. Huge fall. So the disappointment over UAL deal coupled with the losses in the South Mark and integrated resources led many investors to question high value yield bonds. Portfolio managers were dumping their junk bond position, however, without many buyers for the high price. High yield bonds plummeted after beginning the year with outstanding gains. Merrill Lynch index of high yielding bonds returned to paltry 4.2 percentage compared with 14.2 percentage returns of investment grade bonds. By the end of 1989, junk bonds were deeply out of favor in the market. And as earlier, Kohlberg, Kravis, and Roberts have succeeded in purchasing RJR Nabisco for 25 billion, principally with bank debt and junk bonds. Although RJR Nabisco was meeting the financial obligations, when the junk bond market unraveled, RJR bonds declined along with the other junk bonds. In 1989 and 1990, during the junk bond bear market, Buffett began purchasing RJR bonds. Most junk bonds continued to look unattractive during this period, but Buffett figured that RJR Nabisco was unjustly punished. The company's stable products were generating enough cash flows to cover its debt payments. Additionally, RJR Nabisco had been successful in selling portions of its business at a very attractive prices, thereby reducing its debt to equity ratio. Buffett analyzed the risks of investing into RJR and concluded that the company's credit was higher than received by other investors who were selling their bonds. RJR bonds were yielding 14.4 percentage and a depressed price, offering the potential for capital gains. So between 1989 to 1990, Buffett acquired 440 million in discounted RJR bonds. In spring 1990, RJR Nabisco announced that it was retiring its junk bonds by redeeming the face value at face value, and RJR bonds rose 34 percentage, producing a 150 million capital gain. So this is the potential of the so-called junk bonds. I'll explain a little detail about those things in detail, like what they are, why they are called as junks, and all that stuff. So let us see. Okay. The case study is over. So let us understand what exactly the meaning of fallen angels and the junk bonds. Usually, there is some credit rating agencies like in Indian market, CRISIL, Standard and Poor, then Moody's. These are all rating agencies. These rating agencies generally tend to value each bond. They rate it as from AAA plus or AAA to BB and CD, DD, all these things, and those bonds which are investment grades are up to BBB. So these are the grades in which you can invest. They are very stable companies. They have a very good reputation of repayment. Whereas DD, CC, all these things are junk bonds. They may give you a very high yield, but there is again a risk of default. And that is there is a risk of default. That is the reason why they wanted to pay you much higher in terms of returns. So you have to be very careful while investing in such kind of a thing. Many of such bonds are usually, there is a very high risk of defaults. Whereas what you need to do is, as Warren Buffett has done, he had done a careful study of these kind of, bonds which are junk bonds, and he identified there are certain companies, like RJR Nabisco is one of such company, in which the market has, they have actually, we need to understand, there was a kind of a yeah, Robert, this Kohlberg, Kravis and Roberts, they purchased RJR Nabisco for around 25 billion, partially with the bank debt and rest because bank will not fund everything of, what you wanted to purchase. And since the investors aren't much aware about the Kohlberg, Kravis, and Roberts, then generally they may come with some kind of a junk bond to meet the financial obligations. So this is how the junks are issued. Generally, as we have discussed, they will be issued at a face value. But however, when because many of the peers in that particular group have failed to succeed or defaulted, naturally this RBR Nabisco ratings also fell down, and it was badly hit. That is the time this Warren Buffett has realized that it is an opportunity, and he kept on acquiring 440 million of discounted RJR bonds. And within 1 year, RJR Nabisco decided that they will junk all its bond and redeem at its face value. And the RJR bonds rose 34 percentage. That is, see, he purchased at the discount of 34 percentage. So now let us calculate how it materialized when it comes to Warren Buffett. Let's check it. Coming to this Excel sheet, see, Warren Buffett has invested on junk bonds at the price of 440 million, whereas the real face value is it is basically at a discount of 34 percentage. So the face value is the calculated based on 440 divided by 1. 1 is 100% minus, since he has taken at a discount of 34 percentage, you have to write it as 0.34. So this will give you the actual price, face value of this particular bond. And coupon rate is 14 percentage. This is what he will be getting as an interest. So discounting factor I have taken just to have a calculation based on PV formula. So which usually we all have to make a PV calculation, present value, based on discounting factor. So P face value is 666.6667. So even if you say make it to round it off to only two digits, right? I'll just put it as two digits. So you'll get to have it as 667, 666.67. So yield per annum is basically based on not the purchase price, based on the actual face value. So 666.67 is the face value million. So out of that million, what is the amount he will be getting? So it will be calculated if you take 666, this one, instead of writing it fully, I'll just put it like this, and I divide it by sorry, yield is basically into 14 percentage, right? Into take this coupon rate. Coupon rate is basically the interest rate. So you got it. So since the interest rate is common for every year, so it will be for 2 years because he has invested in 8990, assuming that he has invested totally in that. So for 2 years in 1991, they have junked this junk bond and made the entire payment. So at maturity, what he will be getting is 33, the interest, both years interest amount plus the amount, the face value of the amount, not the invested amount. Invested amount is not, the purchase price is immaterial, purchase value, right, basically. So if you add all three together, you'll get this as the return, total returns. Total returns is this many, 853.33 million. And the core profit is basically it is you take the total returns minus 440, which is the initial investment. So 814.33 is 33 million is the actual profit he got, and the percentage profit for the entire transaction is 93.49. Average annual profit is 46.97 based on the calculations we given. If you add PV factor, discounting factor 9% we have taken based on what is given in previous case studies. So if you apply that, the present values keep shifting, and then finally the total returns is 725.3037, and then core profit is 287.3037. So finally the profit percentage is 64.34 percentage, and the average is, assuming it is for 2 years, 32.42. This is the the profit which Warren Buffett has derived, though it is hypothetical because we didn't get the entire information, but yes, he made a profit of 150 million only in capital gain, right? Capital gain is capital appreciation, because the appreciation, the capital gain itself is somewhere around here. I'll just calculate the capital gain. Seven, sorry, this 8 666 minus, you have to see this 440, right? It is 226. However, they have given 130. That means he might have, there is some information which is missing. Otherwise, so this is the capital gain which Berkshire Hathaway got it. So now let us move on to the next case. That case is related to level 3 communication. In 2002, Buffett brought up large bundles of other, high yield corporate bonds, increasing their holding in these securities sixfold to 8.3 billion. It's a huge amount. Of the total, 65 percentage were in energy industry, and about 7 billion were brought through Berkshire insurance companies. So then describing his thinking in 2002 letter to shareholders, Buffett wrote, the Berkshire management does not believe the credit risks associated with the issuers of these instruments has correspondingly declined. And this comes from a man who does not take unaccounted for, read unpriced risk. Okay, to that point, he added, Charlie and I detest taking even small risks unless we feel that we are adequately compensated for. You underline this. So this is the basic, premise which Warren Buffett always have. He always take into consideration even the small risks unless they are adequately compensated. So unless he is very sure of the returns, he won't take any risk. About as far as we will go down the path is to occasionally eat cottage cheese a day after the expiration date of on the carton. So so he doesn't mean going to eat cottage cheese even after the day of expiry date. That means he would like to take a little bit of risk. In addition to pricing his risk, he also usually typically bought the securities at far less than what they are worth, even at distressed prices, and waited unless the value was realized. So what he does take is he invests into the depressed assets, and then he will wait for the asset value to appreciate. That is where he will make the cut. What is particularly intriguing about these bond purchases is that all likelihood Buffett would have not bought equity in many of these companies by the end of 2003. However, his high yielding investment paid off to the tune of about 1.3 billion, while the net income for the company for that year was total of 8.3 billion. So as the high yield market skyrocketed, some of the bonds were called or sold. Buffett commented that at that time was simply yesterday's weeds were being priced as today's flowers. This is the statement. Like it means the company which is junked or which is discounted as a very bad investment, they now are being priced at the flowers because of these, junk bonds which they have purchased, and they had made better appreciation. One is he has purchased at a very depressed rates, then he waited for the capital appreciation. That appreciation has given him good amount of decent returns. So in 2002 July, three companies invested a total amount of 500 million in Broomfield, Colorado-based level 3 communication, 10 years, 10-year convertible bonds with a coupon of 9 percentage and the conversion price of 3.4 dollar to help the company make acquisitions and to enhance company's capital position. The three were Berkshire Hathaway 100 million, Leg Mason 100 million, and Longleaf Partners. These are the three parties which have committed or rather invested 500 million in Broomfield, Colorado-based Level 3 Communications 10-year convertible bonds. And technology intensive companies are not Buffett's normal acquisition fare. He candidly admits he does not know of the way to properly value technology companies. This was an expensive deal for level 3, but it gave them the cash and credibility when they needed it. For his part, Buffett obtained a lucrative 9% investment with an equity position, and at the time, Buffett was quoted as saying that investors would expect 7 to 8% return on stock market annually. So at 9 percentage, he was ahead of the game. So you always remember, see, don't be very greedy. Even 1 or 2% appreciation also, it's a very decent return. See, in this case, the market, the returns in the stock market are just 7 to 8 percentage, whereas this particular junk bond gave 9 percentage appreciation, which Warren Buffett appreciated it because it's always better to have, a known angel than an unknown, sorry, known devil than an unknown angel. Or when for sure what is the amount is being repaid, so he is very sure of it, then there is no point, assuming that market may grow and it will appreciate so much that it will do very good. But generally, it won't happen that way often. Many a times, the markets may go crash or, sometimes the yields are very, very less compared to even bond yields. There is another story that is typical of Warren Buffett, a strong component of managerial integrity and personal relationship, which we already discussed in all his case studies. Only common pattern or common principle behind every investment is he always look into how competent is the managers and their integrity and personal relationship. So level 3 communication was a spin-off from an Omaha based construction company, Peter Kevitt's Sons, Buffett's friend Walter Jr. Scott Jr. is both chairman and emeritus of Kevitt and chairman of Level 3. So Warren Buffett is already familiar with the company, the management, and it is also from the same place where he belonged to. So he know ins and out of this company, though he is not very sure about or rather uh, uh, comfortable with the technology kind of a stocks. Since it is a debt, he went ahead instead of going for a the equities part. So often called Omaha's first citizen, Scott was the driving force behind the city zoo, its art museum, engineering institute, Nebraska Game Parks Foundation. Scott and Buffett have a close personal and professional connection. Scott sits on Berkshire's board, and two men are only floors away from each other at Kiewit Plaza. Indeed, the Berkshire Hathaway or the office of Warren Buffett at one stage was at Kiewit Plaza. Even today, it is at that place. So it is indeed this Scott who happened to have been the driving force. behind so many developments in that particular city. So they both had a very close connections. And then again, this guy Scott is again a manager in Berkshire Hathaway. So both are very well known, very familiar with each other, and Buffett know very well about the company also. So he had a very high regard for Scott, and he wanted the investment to be fair and transparent, with no question that the relationship between the two men unduly influenced the deal. So Buffett suggested that Mason Hawkins, chairman and chief executive of Southeastern Asset Management, which advises Longleaf Partners, set up a deal and negotiate the terms. So he put a middleman to negotiate the deal, so that he don't get influenced because of the personal relationship between Scott and Buffett. So by the end of 2003, a year later, Buffett, Legg Mason, Longleaf Partners exchanged 500 million for a total of 174 million level 3 common shares, including extra 27 million as an incentive to convert. Great, it's an excellent deal. And Longleaf had already converted 43 million earlier in the year, and then converted the rest before 57 million. Buffett received 36.7 million shares, and in June he sold 16.8 million for 117.8 million, and then in November he sold an additional 18.3 million for 92.4 million. So sure enough, level 3 made good on its debt pay repayments, and by the end of 2003, Buffett had doubled the money in 16 months. On the top of that, his bond earned 45 million of interest, and he still held on to 1.6 million shares of level 3, right? And I think I need to do a little bit of calculation so that it will become very clear. We need to understand Warren Buffett had invested only $100 million in that, and this is basically a kind of a convertible bonds. So he converted into shares, and let us see, this is the initial investment, and then what he got in the deal is he got 36.7 million shares after conversion. So let us do the calculation so that we will understand how much he has actually gained. So I'm going for to the Excel sheet to make the calculation. So I made a little bit of calculation related to level 3 communication, bond purchases. There was basically a kind of a consortium in which Berkshire Hathaway has invested only 100 million, whereas others have invested one company. I'll just show you. See, in this, um, sorry. See, Berkshire Hathaway of Warren Buffett invested only 100 million, whereas Legg Mason, another investor, he invested 100 million, and Longleaf Partners, the major negotiator, they invested around 300 millions. So this particular table, or the Excel sheet, gives you about how much he has gained within that 16 months holding period. So what Warren Buffett invested is only just 100 million, whereas the equity conversion rate is 3.41 for each bond they have purchased, and total shares obtained by Warren Buffett is 34.8 million out of 174 million invested by the consortium of three players, Meg, then your is that Meg Larson, Meg Mason, Longleaf Partners, and Warren Buffett. These three combined together, the total investment is around 500 million, out of which 174 million shares are being exchanged Out of this, 27 million is incentive given by the company for converting into equity. So they got a pretty decent amount of incentive. As in terms of percentage, it would be 27 divided by instruments. So as a percentage, 18.36 percentage over what they have committed as an incentive just for converting into the stock equity. Because see, a debt comes with a fixed charge, and that is the outgo for the company. And in case if it is converted into equity, the equity holders are paid only dividend, or many a times they are not even paid that. So that is the reason why they have given this particular incentive, because it doesn't cost the company much, and they wanted to incentivize the investors. So the holding period is only for 16 months, and the shares for 1 million is just 34.8 million. This is what we have come to. And then he sold both the investments in at different intervals. What he sold is around you know uh, 16.8 million at one stage, and at the other stage another 18.3 millions. In two phases he sold it. So he sold 34.5, means he might have got even some incentive as a bonus at the later stage. So he sold it for 117.6 million in one go, and the second sale is for 92.4, and he also got 45 million as an interest charge. So if you add all three, the total proceeds are 255 million, out of which the initial investment is only 100 million. So if you deduct 255 from 100, he got core profit of 155.5. And in terms of annual yield, let us see how much, because the holding period is only 16 months. Let us calculate how much he got it as a yield. So it is basically 155 divided by 100, right? This is 1 into number of months are just 16 months. So what you should do is into 12 divided by 16. This will give you an idea about what is the rate of return which he has got it. It's around in terms of percentages, 116.25 percentage. By any standard, it's very, very, very high. And you just see there that too in a company, in a technology company, which Warren Buffett is not at all, comfortable with. See, this is the genius of Warren Buffett seeing an opportunity in this, and this is how he made huge amount of profit by selling equity. So I'm just showing you some of the case studies in which even in bonds also you can make decent amount of money. So with this we are stopping this session, and later we will continue with the rest of the case studies. They each of the case study is unique and they are totally different, unlike the equity. That is why I'm just covering all the bond case studies, and finally maybe in the next session we will be covering something related to yeah, this so-called bond case study of Quest, then Amazon.com, then arbitrage, and we will cover convertible preferred stocks. So with that, I think convertible preferred stocks case study may be taken in the another session. So uh, then later we will move to psychology of the markets, and there are so many other subjects to be covered. So this is a series, so let's get ready. So thank you guys for your patient listening, and shortly we will meet. At the later stage, maybe in this weekend, there will be online, and I have delinked both online session and then the recording session. Recording will continue after online, so that because I am facing a lot of problems, dealing with the online kind of a thing. Many times recordings are not proper, and at times, things are going awfully bad, especially with the audio. So now I thought it would be better if it is a recorded session rather than having, online. Online will be totally separate, and this will be totally separate. Online is for the benefit of those people who wanted to participate in online session. Thank you, dear friends, and we will be meeting again on 1st of June, which is the next weekend. Thank you.